Assalamu alaikum. Good afternoon, everyone. My name is Umar Asway, and on behalf of the Investment Club, its leadership, and all its members, I would like to welcome you all to the last lecture for this semester. Throughout this period, we tried to cover all the different fields related to the investment world, starting from venture capital to private equity and ending it with equity markets. And for our guest today, we have Mr. Abdulaziz Naim. Mr. Abdulaziz is an MIT graduate. He started his career as a financial analyst at Saudi Aramco, and then he went to co-found Yaram Arabia. After that, he co-founded Atal, and in this time, he founded the Mayaf Capital. And I don't want to risk to spoil anything, so if you could please give a big round of applause for my colleague Salih Al-Aqib and Mr. Abdulaziz.
Just a quick correction for the record. I co-founded عقال الشرقية. عقال في Riyadh was in existence. Faris al-Rashid and that group had already started. To give them credit where credit is due.
Thank you, Umar. Assalamu alaikum, everyone. First of all, I'd like to thank you all for being here, especially Mr. Abdulaziz, who despite running an awfully tight schedule, has dedicated some time to share his experience with us. For those who just took their exams, I hope you did well. I know I didn't. For those about to take their exams, good luck and try to skip worrying for the next few minutes. Inshallah, the discussion will be divided into three parts. First, we'll talk about Mr. Abdulaziz's early career. How did he get into finance, his education, what tipped him off, and so on. Then we will move on into the start of his professional career. Where did he work? What did he learn? And so forth. And then in the last stage, we will focus solely on Mayar. How was the experience? What were the challenges? And so forth. The time allotted for this discussion is going to be 40 minutes, give or take. And then for the remaining 15 minutes, we will open the floor for any questions if you had any. But please, no Aramco. We had enough of that. So let us delve right in. Mr. Abdulaziz, how did you get into finance first? I've heard that your heart wasn't exactly into the investment world at the beginning, but then something changed. So can you tell us more about that, please?
Sure. So I grew up basically most of my life. I was a computer geek. So most of what I was interested in growing up were computers and software specifically. And I ended up going to MIT to study computer science and electrical engineering. And I started there. And to put things in perspective, this was around 99. And the tech bubble was in full boom. And at the time, Merrill Lynch in New York was doing summer classes or not quite internships, but for some of their clients. And one of my friends, Saud spent the summer there. So we met that summer, and he'd come. We met in London that summer, and he started talking about stocks, and which I've heard a thing or two about. But I worked in National Commercial Bank some summers, but I didn't quite know exactly what they were. And then he also mentioned this guy called Warren Buffett that I hadn't heard about at the time. And then we walked over to a bookstore, and he showed me a couple of books. He said, you need to buy these and read them. This is really interesting stuff. You really need to get into it. So I remember I flew back to Boston after the summer, and I went to the Harvard bookstore in Harvard Square, and I bought 4 books. The first one was the book that Saud had recommended, which is The Warren Buffett Way. I bought a second book by Peter Lynch called One Up on Wall Street. And then I bought two books that were very symptomatic of the time. One is called Day Trade Online, and the fourth one was called Technical Analysis. And to this day, honestly, I do not know if it was dumb luck or divine intervention. But I read One Up on Wall Street first. And there aren't a lot of moments of life, I think, where you get clarity on an idea, when just something clicked. It made a lot of sense to me. And then I read The Warren Buffett Way, and I was completely sold. Everything, just the whole process, the whole approach, just really made sense to me. I never read the other two.
The technical.
Yeah, and I always say I keep them on my shelf as a reminder of the role of luck in life, because luck plays a big part in everything that we do, but especially in the investment field. I think one needs to remind him or herself that it's omnipresent. And then over the next 2 years, I just started reading every investment and business book that I could get my hands on. And then I also started reading annual reports. And I remember at the time there was this website that you can go to. I don't remember the domain, but you could go to this website, and there's a list of companies, and you pick an annual report, and you put in your address, and they would mail like the physical report to you. So you would wait for it for a while until you get it. But I ended up with these piles and piles of annual reports, and wherever I went, I took some annual reports with me. And there's a funny story that we don't have time to get into, when I took a box of annual reports on vacation with some friends, and they did not appreciate that that was my plan for a spring break.
Casual reading.
Yeah. But I learned basically by reading these things, and then I started taking finance and economics and accounting classes as electives.
Were you majored in finance?
I was still majored in computer science and electrical engineering at the time, but taking these business classes as electives. MIT has a fairly flexible definition of electives specifically. There's a lot you can play around with. And I was sponsored by Aramco at the time and CPC. And I don't think my advisors, I shouldn't be saying this on live, but I don't think my advisors noticed all these business classes that I were taking. And so 3 years into it, to start with, I discovered when I got to MIT that at best, I was going to be a mediocre engineer. By global standards. So it's not like the world lost this brilliant.
They gained a brilliant investor.
Well, I don't know about that, but I realized. I remember there was, and then anyway, 3 years into it, this finance professor called me up to his office hours, and he said, I've been looking at grades, and you've been getting the highest grade every single exam that you took with me. And I talked to some of the other professors, and again, you were at the top of their classes. And when I looked you up, you're registered in the engineering school, so what the hell are you doing there? And I said, well, I don't know. I was sponsored by Aramco. They sent me here. They said, you should study this, and I'm studying this. And he said, so are you happy there? And I said, no. He said, are you good? And I said, no. He said, well, you need to figure something out. And so I said, okay, fine. And Saud actually, who by the way, I don't know if he's ever going to watch this, but there's a recurring theme in my life where I'm just about to do something stupid. Saud always jumps in and pushes me in the right direction. So I was having this conversation with him, and he's like, yeah, what the hell are you doing? I said, well, I don't know what to do. But he's like, well, what you do is you go back to Saudi, and then you lobby everybody that you know, and change your major. And my father was an executive in Aramco at the time, so I said, well, maybe if I go and talk to him, he'll support me. And he basically said no. And then after a lot of pushing and lobbying with him, I think my mother never got over it, honestly. But He said, well, you know what? I'm not going to help you. But if you manage to lobby people in Aramco to accept it, then fine, whatever. So I ended up talking to different executives. Everybody who was involved spent like the Christmas break lobbying different people, meeting with them. Eventually, I was able to get enough support to switch my majors from Aramco. And then I went back to MIT. And then actually in my last year, basically, switched my major officially. And the funny thing is that at that point, I discovered that I had about 6 engineering courses to go. But I was essentially finished with the business degree. The only thing that I didn't take were these 101 introductory classes, which I didn't need to take because I was taking the classes for fun. So actually, my last semester, I took every 101 class in the business school. Yeah. So I took statistics 101, I took accounting 101. So it was fun. But that's how I got into it. And along the time, I digress, sorry, a lot of detail, but I started to invest some of my own money.
I was coming to that.
Yeah. And I opened a brokerage account. And this broker used to be Daytech, which eventually got acquired by Ameritrade, and then Ameritrade became TD Ameritrade, and just now, this last month, it's going to be acquired by Schwab. So, and I was like, okay, this value investing thing seems to be working out, and so one of my friends gave me $1,000. And my
the first
sister,
time you managed to manage.
yeah, and then my sister gave me $550. So they were my first 2 outside clients. I didn't have an entity or anything, but I started using fund accounting for that brokerage account so that the reporting would work out. And then when I graduated, I asked around what to do, and I decided that this is what I wanted to do. And they said, well, nobody's going to give you money unless you have a track record, and that track record needs to be audited and needs to be in some kind of entity. So I set up an offshore LLC, which is Yareem Limited. Put that money in. I'd sold my car, put that money in, and a few friends gave me some money. And then in the summer of 2003, we launched that money is essentially still in the fund. I think at the time it was $65,000. And then between gains and some other money that we raised, we closed 2003 with net assets of $97,000. And that was basically, there's a straight line from there to my out capital. But that's how it started. You mentioned that I worked in Aramco. So yes, I did come back and I worked in Aramco for 4 months. I resigned 3 times in those 4 months. And with the benefit of hindsight, it was a stupid move, but I was just fed up. I'm not good with, I think, with big companies. I'm very stubborn as well, so I'm probably not good as an employee and not good with bosses, so that probably didn't help. But eventually I left and did that for a while. 5 years later, which was the original plan, you need 5-year track record to get money, was 2008. So there's no way I was going to raise money in 2008, even though the track record was good. So the plan had to be postponed a little bit. And end of 2010, I felt things had kind of stabilized and launched in 2011.
Quite the right. We'll take you back. Usually when you hear the stories of great investors, you will hear that their first investment was some very weird company that is priced, say, $10 or $5. So they thought it was cheap. So they loaded on it, and the stocks just triple or quadruple. Do you have any kind of experience? What was your first investment? The first time you put money actually in the market?
You mean into stocks?
Yeah.
Because when I mentioned there earlier, I worked in the summers and CV, and I'd bought some mutual funds, but I didn't know what they were doing. But I remember the first 3 stocks that I bought in that account. It was nothing exciting. I bought Oracle, Walmart, and Dell. and I don't remember which one was first, but I remember those were the first three, and I have no idea why I bought those three. But that was around New Year 2000, I think, or a little bit later.
So at the peak of the
Yeah. I mean, one of the greatest things that happened to me, again, back to the role of luck, is that I started investing in 2000. And so nothing humbles you more than
counting a
than a
peak,
market
yeah.
than a market decline by that much. It's really, and nothing destroys, I think, learning like a huge bull market early in your career, because you learn the wrong lessons. So I got in 2000, and then 2001 came, and then 9/11 came, and then 2002 happened, and then a few years after that, there's a great financial. I had a lot of kind of punches in the face throughout, and I think that makes you a better investor to go through adversity. But after those three, I don't remember why I bought them. There's probably no good reason. But very early on, and this probably is the story of many value investors. The stuff that I want to say that we were buying, because also I mentioned Saud earlier, but we had the partnership of some sort unofficially at the time, so we were doing a lot of research together. We were buying cheap stuff, ugly stuff, kind of what people call cigar butts, so nets and which wouldn't have worked in 2000, but again, it did work in the early 2000s, kind of out of that, because they were not bid up like the some of the tech stocks. But that's what we started doing, and for me, I think it didn't take me very long, and I don't know that I graduated into. Some people now use the term quality investor. I still like cheap stuff. I like stuff on sale. It's the Qasimi in me. But I quickly realized the importance of competitive advantage, economic modes, and that you do want to pay up a little bit for a better business.
So you were solely focused on stock markets back then, or do you have any other sort of entrepreneurial projects? Or
so in the early 2000s, I was doing mostly U.S. stocks. In 2005, a group of friends and I started a company called Yarim Arabia, which eventually became a multi-restaurant, multi-unit, multi-concept restaurant company.
Was the same Yarim
in the Eastern Province. The naming was unfortunate, which is one reason why Yarim Limited ended up being folded into a new name, Mayab Capital, because kind of the restaurant business took over the name. And that started out with a concept called Otakushe, which is a socially responsible cafe with a lending library. We were the first to bring organic fair trade coffees, teas, and chocolates.
Where was Yarim operating?
Al Khabar. And then we ended up with a burger concept, and we branched out a lot, I think. And for a while, I was chairman, then I was CEO. I kind of changed roles with the other partners over the years, and while that financially wasn't as rewarding of an experience, for me, it was an amazing learning experience. I think having gone through being that closely associated with an operating company and seeing how companies are built and operated, it definitely made me a better investor.
So that was in 2005. You kept working on Yarim until?
So that was kind of a side gig, essentially. So between 2005 and 2010, I did both the restaurants and the investing. And around 2010, I decided that I wanted to focus on the investing. Like I mentioned, the plan was going to launch in 2008. That didn't work out, so kind of that got postponed. And towards the end of 2010, I handed over the Yeah, Yarim Arabia, the restaurant business, handed over to my partners and completely left the business to focus on Mayal Capital.
So let us jump into Mayar Capital now. Mayar Capital was founded in
March 2011.
March 2011. What was that? What was that like?
It wasn't a bang or anything. Like I said, it was.
An evolution. So
I wanted to do it earlier. I couldn't in 2008, and so Yarim was an investment company, and I needed to set up an asset management company and a fund, and that's more expensive to do as a setup, but it's the proper structure if you want to raise money from outside investors. And I didn't want to go through the expense before I secured at least some amount of investors. And funny enough, in late 2010, early 2011, I started talking to some people about seeding the new fund, and I got some commitments. And at the time, it was about $5 million of new commitments, and I'd had $1.84 million in the old fund by then. Combination of gains, and it wasn't from the 97,000. It was money raised and some gains on top of it. And then I say, okay, I've got this 5 million coming. I can launch. So I went through the paperwork and the legal stuff, and I launched. The firm was set up in March of 2011, and the fund, Mayar Fund, launched in May 16th of 2011. The funny thing is that money never came. So the commitments, the 5 million commitments, it never came, and so thinking back, I mean, alhamdulillah, it happened. Sometimes you don't know, yani, what's good for you. But I probably wouldn't have launched with 1.8 million. I don't think it was a viable business at 1.84 million. But those people promised me money that never came. But that gave me the kind of the push to do it, and alhamdulillah, things worked out.
And why did you take the jump at that time exactly? You had the restaurant going well, so why did you keep just working on both sides?
Several reasons. I mean, my heart was always in investing. So that's one thing. And the other thing, I didn't think it was fair to have outside investors and kind of do both things. I felt that it was, I needed to promise my partners that I'm going to focus on these things and not kind of do a couple of things here and there.
Beside picking stocks, for anyone here who's interested in launching their own asset management business, what are the most difficult things that you would say from your experience? Because there's a lot of dreamers here.
How much time do you have? I think one of the things that I knew to some degree at the time, just because I'd gone through the restaurant experience. So again, another valuable way where it helped me. But a lot of people don't really think through this when they launch their own asset management firms, and I know several people who learned it the hard way. When you do that, you're basically tripling your
risk.
Well, tripling the type of work that you do. Because yes, you're going to be wearing the portfolio manager's hat. But on the other hand, you're going to have kind of the entrepreneur's hat, and then you also have the owner's hat. And the three are very different. I think the one where most people struggle because they're not trained for it. And I got lucky by chance that we did the restaurant thing, so I'd gone through a startup before. Is the entrepreneur hat? It's very different. I mean, and then I did this by myself. I mean, until 2015, I had no employees.
Until
2015.
Wow.
So I worked by myself for almost 13 years. And you need to understand how to do the accounting for your firm, and you need to pick stocks, but then you also need to make sure you have enough printer ink, you know where to buy it, and your
Business
lease.
card.
And then once you start hiring people, you need to manage people, and you need to know HR laws, and you need to deal with payroll, and you need to deal with all kinds of business issues that kind of managing any small business is a struggle always, just because you don't have the resources of big business in terms of specialized departments and things like that. So you're always wearing these different hats, and the purchasing manager and the IT guy and the marketing to new clients and
Legal.
the portfolio manager and the legal and everything. And I think that is a challenge that is underappreciated. And I don't, even though I've gone through that experience, I don't know that I even then appreciated that difficulty. I think the investing with the benefit of hindsight for most people who are in this position may turn out to be the easy part. It's usually the managing of the business and the raising money that's the tough part.
So the secret sauce is open a restaurant, then go to Torrevieja.
Open a restaurant and see it fail.
Yeah. Okay, so that basically covers the entirety of the three stages. I have a couple more questions that are more general and broad.
Sure.
Beginning by why value investing? I know you've struggled with that question and you came up with a brilliant answer. If you might share it with us.
Well, if you know it.
No, it's all yours.
I don't know that I have a brilliant answer. What's the answer that I think I have?
I think you mentioned how incentive work on the short horizon and all the different fields that are related to the investment world, and that favors being more long-term, more. So did I get it right? Or?
Yeah. I mean, I think that's that, and I'll get to this in a second. But I think that part is why I think it works. But I also want to mention something, which is I don't think that value investing is the only right way of investing. And I think a lot of value investors just come with this kind of religious fervor where like it's either value investing or you're kafir. And I don't think that's fair because I've come to the conclusion that the best kind of investing is the investing that fits your personality and your capability, of course. But people underestimate the importance of the fit and personality between how you invest and if there's a mismatch between the two, and I've seen it, it just doesn't work.
Between the personality
and the strategy. And I think the strategy really needs to fit. And some people just are anxious and they want to act and they want to do something, and they cannot be successful long-term investors. And I don't say that in a bad way. I think they just need to do something that fits them. Otherwise, they're going to have this itch all the time to do something, which is the opposite of at least long-term value investing, where I'm much more interested. In a sense, I'm lazy in action. I'm more interested in kind of just sitting and reading and kind of thinking. So it fit my personality, and I think there is a sense, which is also part of personality. Buffett calls it temperament, but it's essentially how you react emotionally to triggers. And some people I think are, and I don't mean this in a bad way, but Buffett says that he basically implies that value investors are born, not made. And people say, well, how come? And I don't think it has absolutely anything to do with skill. And I think there's truth to it. But I think it's two parts. I think there are people who, and I'm not going to make more stereotypical jokes, but who like bargains. Like there's something in their blood where they like buying things cheap and at a discount. And I think some people just don't have that. And it has nothing to do with intelligence. If anything, maybe there's a slight negative correlation in life. But you either have that kind of itch to buy things for cheap or you don't. But more importantly, I think it's a combination for value investing to work. We'll circle back in a second. Value investing, we need to be able to be a contrarian. And to be a contrarian, you need to be kind of able to be emotionally distant from triggers. And I don't know if it's when at some point your mother drops you on your head, or there is something where some people are more easily emotionally triggered and some people are more stoic and are not. And I think that's very important in terms of personality to fit value investing. The two other things is that why it works and then why I picked it. So why I picked it is, I mean, I mentioned when I read One Up on Wall Street and then in the Warren Buffett way, the idea that buying something for cheap, buying at the outlet mall instead of the full price store, that has always appealed to me. It just naturally made sense that yes, I'm gonna buy something when it's on sale, not on full price. So there is that aspect to it, and then the other aspect is that perhaps more than anything, the part that I find the most interesting about my job is learning about businesses. So really, I'm very intellectually curious about business models, how they work, and that's the part that I enjoy the most. Just finding a new business, especially if it's a new business model somewhere in the world where that to me is the most appealing. And we talked earlier about picking a geography to invest. That is probably the main reason why I picked investing globally. Is that, well, there are just these tens and tens of thousands of companies around the world, and the odds of me finding a new business that I haven't heard about, learning about it, or a new business model in some new country, I found very appealing. So that's why I think it fit me, just fit my personality. And then, I mean, at Male Capital, we always say there's the kid's story, the tortoise and the hare. We're always the tortoise. We're happy with it. It's just
It works.
we have no problem with not being the faster. And I think someone asked Buffett if it's so easy or so obvious what you do, why don't you do? Why doesn't everyone do it? And he basically said people don't like getting rich slowly. It's just unnatural to most people. The idea that you mentioned about why I think assets can, at least it's one reason why assets can be mispriced is, I mean, there's a fancy name for it that people came up with. They call it time horizon arbitrage. And it just means that there's a difference in the time horizon between what the underlying business should be measured at, or the underlying reality of that business, and the investment horizon of the average, not necessarily holder, but the buyer and seller of, in this, if it's a stock, the shares in that company. And so people buying and selling, if you're buying something, someone is selling it to you, and one of you is wrong, right? I mean, you can get into the whole concept of market efficiency, but for you to outperform, one of you must be wrong. And in this case, I think it's a way to realize how you can both be right. The person selling to you is right about the short term, and you're right about the long term. And then the next step after that, you have to ask yourself, well, why don't they do the same? And my realization after many years of thinking about it, because initially I thought I was smarter than everyone else, but I discovered that I cannot be. The odds just are very unlikely that I am. And so I've got to have another kind of competitive advantage. And I think time horizon arbitrage is one. And the reason why most people don't have a long-term horizon is that they can't. And it's often for structural reasons, which I think is I think I mentioned this on one interview a while back. I think it was in the Manual of Ideas, which is at least in the developed markets, the majority of owners are institutional investors. So when you're trading, buying or selling, the other side is more likely to be another fund manager. The ultimate beneficiary owner all the way at the top is an endowment or pension, which in theory should have like a 40-year investment horizon. But in reality, there are people sitting in that institution whose job is to select managers. In this case, in this example, equity managers. So this investment committee has to make decisions on where to allocate capital to which managers. And they're overseen by a board of directors or board of trustees that are on a cycle as well. And so if you look at the board of trustees, they probably are measured over a 4 or 6 year cycle. They have to oversee an investment committee, and they have to judge them, and they have to judge them at least a couple of times during their tenure. So effectively the investment committee becomes effectively has a 2 or 3 year investment horizon. I mean, there are differences around PE and all kinds of ways where that's not completely true. So I'm oversimplifying a little bit. But they know that in 2 or 3 years, they have to report what happened to the managers that they selected, especially once in a bigger institutions, you actually have an investment committee, and there are allocators under that investment committee that are reporting to the investment committee, that's reporting to the board. And so if you're the allocator interacting with the fund manager, you've just compressed a 40-year investment horizon down to probably 1 year, maybe 2. And if the manager, in this case, is the big institution, Fidelity or Schroders or whatever, then they have to judge the portfolio manager, who's the employee, in a period that's shorter than that. So portfolio managers end up thinking quarterly instead of 40 years, even though the ultimate beneficiary owner has a 40-year horizon. But the key here is that everyone in this cycle is acting rationally from their own incentives point of view. And so anything that you can do as an investor to not put yourself in a position where you're in that cycle gives you an edge. And it's very hard. It's really hard if you manage outside money. It's a lot easier if you manage your own money, but it's definitely harder if you manage other people's money to do that. And there's no perfect way of doing it. In a perfect world, you'd have something like a Berkshire Hathaway where you've got permanent capital, it's locked up, and Buffett controls the shares. So you could hate him, but you could sell the shares, but that's it. Nobody's going to take away the money. And short of that, you can have cultural differences. I mean, we effectively, our team owns the firm. That's as much as you can do without, and then you try to educate people, but it's structural and it'll always be the case. I mean, and it's a struggle to overcome it.
Thank you. My time is up, so I will open now the floor for any question. If anyone has any question.
First of all, thank you, Mr. Abdulaziz, for coming today.
No, thank you for having me.
Some of your valuable time. You mentioned the governance problem with the pension funds and the endowment funds, where the portfolio managers think quarterly or short-term horizon. How to align that with the interest of the people that really have the interest, whether the people that put the money or they're thinking long-term horizon.
You got the question? Or?
Yeah, I got the question.
It's a difficult one.
So just to make sure I understood it correctly, what is the policy that you can implement to kind of bridge the gap between the ultimate beneficiary owner's long-term horizon and the fund manager's short horizon. Is that the question? Okay. I don't know. I mean, from a policy point of view, it's very hard. Whenever, I mean, you can probably solve the top part of it. So you can probably solve it inside kind of the pension itself by having longer term, 10 years. Some people have done different things by having a team approach in terms of allocation, so no one individual is under pressure to be responsible for the performance of one manager. But that introduces another kind of problem. It solves one problem, which is the horizon, introduces the responsibility problem. So you always have some kind of agency issue. Culture probably helps. Some institutions tried by effectively locking themselves into longer allocations, which is probably why illiquid private assets work better for them. So a lot of the success of private markets, private equity, and such, I think, has to do with locking yourself up and losing that option to liquidate. That it's really unbelievable how something that should be a net positive, which is liquidity, can turn into such a negative by messing with the psyche of investors. People find much harder to, so much easier to invest long term if they own a building or farmland or PE for, they have no, or their own business. They're not getting a quote on that every day. They're not checking the value every day. They don't seem to be bothered. But the second you put a quote in front of them, even though they are under no pressure to do anything about it, they start to freak out.
Well, you got your answer. Any other question, please?
Thank you for putting the event together, and thank you for talking to us today. My question will go to the private companies that these days stays longer private before they go IPO. And still when they go IPO, we don't see profitability. And some of them stays for like this for a while. What's your take on this?
I do think it's a net negative for markets. Of course, I'm biased because I'm a public market investor. But we've seen, I think there was this absurd notion, in my opinion, that private markets are going to be better at setting prices and valuations than public markets. And then that was kind of a theme that was going on for the past several years. And we now see that when these companies go public, that the public markets just kill them. I mean, they're like, you guys are ridiculous. You don't have a business, or you should be worth 90% of what XYZ paid for you. It's very hard to predict the future. If I were to make a bet, I would say that there's going to be a reversal in that. A lot of the losses that these companies are doing.
Reversal meaning going private again?
No, I would say that more companies are going to go public earlier.
Okay.
There have been a lot of enablers of this kind of behavior. It's not, a lot of these losses don't need to happen. And if they were public, they would not necessarily have happened. But companies were incentivized by cheap access to capital, and in some cases by huge access to capital, to basically expand beyond what they should expand, and take a risk and hope that it works out. And I don't think rationally they would have done the same had they been under pressure, more pressure to actually make money. And I think a combination of low interest rates, a fashion for private markets, a push by, which, I mean, again, when institutions, the endowments of the world, and when they move their portfolios into an asset category, that's a lot of money that flows in. And then I would argue the epitome of that is a technology investor that raises 100 billion. And when you got all that kind of money where you're a startup and you get tens and hundreds of millions, what are you going to do with it? You have to spend it somewhere, which means you have to grow way beyond what you expected in order to justify the valuation that you now got. So a lot of it is self-enforcing, and I think at some point we're seeing the evidence that this was all a stupid mistake in terms of funding these startups at these valuations with these amounts. And I think people will realize that they need to scale down these things, which means that if you are a private company, you're going to have to go public earlier in your life in order to do it, which means you're going to have to become profitable sooner.
Great. Any other questions?
Thank you for coming today. Actually, I will read
Allah Zakir.
I see your top, your 10 largest companies, not from our region, I mean GCC. I see that your main focus was in the developed market. Is that like something in the mandate from you don't see good opportunities in this region, different countries in the world like China, Asian countries?
Yeah, I mean, as it is today, it is just an issue of mandate. There are a couple of reasons why we ended up with this mandate. One is I mentioned earlier that one of the reasons I got attracted into this field is that I'm just very curious about discovering new companies and new business models and new geographies. So there's a selfishness there. And when I started that, this is what I found fun, basically. And so the bigger the universe, the easier. The other reason is that in the very early days, a lot of our and to this day, though, you can argue it's a chicken and egg problem with this, but we help people diversify their holdings. A lot of our investors are based in Saudi or the region, and they have access to excellent managers here. And a lot of them actually manage their own money, and between their businesses and their investments here, they don't need us here, or at least at the time. They didn't need us at the time. So it kind of evolved from that point of view, combination of my interest in certain markets, the fit for our investors is probably the region. A different kind of flip of a coin at some point many years in the past could have changed that. I mean, I don't think there's anything. What we do can be applied, I think, everywhere in the world. I don't think that there is a reason why it needs to be applied in one geography or another. The difficulty changes and the disclosure changes, but then the returns also are probably going to be better for the effort expensed.
I mean, if you have looked into like Japanese stock market or even South Korean stock market, there would be, I would say, very good value stocks out there, and you could diversify maybe those say, markets you're exposed to, and doesn't they, I mean, fits into your focus as a developing market?
And we do, on average, any given, our portfolio is fairly concentrated, so it changes a lot. But historically, we probably were between 10 to 15% in Asia. We own Samsung Electronics right now, so we do have Korean stock. We owned a Japanese company until not that long ago. Until a few months ago, we owned a company in Hong Kong. So we do have exposure to Asia. China is a different market in the sense that as outsiders, we struggle to have a good handle on access to information, but also understanding. But that's today, and that will probably change over the next years and decades. It's such a big market that at some point I'm sure we're going to end up there. But also a lot of the companies that we own have massive Chinese businesses, even if they're listed in Europe.
Any other questions? Please.
I want to ask, how do you get over the hurdle that some investors see it's better sometimes to invest into just an index instead of a management fund that takes fees and performance fees as well, that they could get similar results if they just invested into an index fund?
Anna, to add on that, will we have a job for years into the future, or?
I mean, that's essentially the question, the $1 million question for our industry. Because index investing is cheap and, well, you don't need human beings to do it anymore. I think for me, it's always healthy to think of the index as your opportunity cost. So I remember when I launched, I had a discussion with my advisory board and some of the early investors about what kind of hurdle should we pick. And I'm sure there's some chapter in your finance books that talks about what makes a good benchmark. It needs to be investable, it needs to be liquid, it needs to be representative, and all of these things. And so we ended up not picking an absolute benchmark because of that. Because the alternative is, in our case, the MSCI World, so which you can buy for, I mean, last I checked, 20 bips or something like that. I mean, yeah, you can get the S&P for basically zero now. And that's the challenge for the industry. And I think the industry got too lazy, too complacent over the past 30 years, and is paying the price for it. I think I wrote about this once. The key determinant, well, to answer the question basically at the top level is you should not invest in an active manager if they cannot beat the market, either on performance or risk. I mean, you need to do better in one way, and if you can't, then they should not have a job. That's the short answer. And then the question becomes then, how do you put yourself in a position where you could maybe have a job? And I think the key is active share. And if you see historically, basically all of the alpha being generated by the industry is generated with people with high active share.
Active share meaning?
So active share means the percentage where your portfolio